Hello, my name is Juan Echanove, and I am the Associate Vice President for Food and Water Systems at CARE. And in the next 10 minutes, we will briefly talk about access to finance by small-scale producer groups. Small-scale producers, farmers, fishers, livestock growers are the main groups that CARE work with, and predominantly women small-scale producers. First, let's talk briefly about the different types of groups that small-scale producers normally are organized on. And much of the work of CARE is not directly with individual farmers or producers, but via collectives, via groups. So on the one hand, we have informal types of groups like village saving and lending associations, which is a very predominant type of collective that CARE work through in accessing small-scale farmers. But there are also lots of other types of informal groups of farmers. And then there is also formal groups, including cooperatives that exist in many countries, or SMEs, micro-enterprises, where different farmers may work together, or associations, and there are plenty more, right? So these groups of farmers, these farmer groups have different types of financial needs. But simplifying things, we can say that on the one hand, they have to afford investments. And investments means investments for starting up the business, like a new group of farmers that need to access land, or a group of fish folks that want to buy a boat for fishing, or maybe to expand their business, meaning accessing new land, or maybe developing infrastructures like a silo or fencing their farm, or maybe production equipment like buying a tractor or processing equipment, right, for processing the food that they are producing. But aside of investments, they also need working capital, meaning running costs that they have to deal with regularly. And that includes inputs such as seeds or petrol for some of their equipment or fertilizers, as well as service like maintenance services, for instance, for their equipment. Or if the group has employees, employee salaries. So on the one hand, we talk about investment financial needs and working capital related financial needs. And this distinction is really very important. Finally, you have risk management costs, meaning cost of insurance, cost of savings. So this is the financial needs that relate to how farmers can live with shocks to be more resilient. Investment financial needs are higher, they require more funding, but they are punctual. They happen at given points during the life of the farming business of the group. Working capital is smaller and risk management, but it's more regular. It's something that the farmers have to afford regularly. So we talk about the types of expenses of the farmers. Let's talk about the income sources, because in fact, there are different types of sources for the groups of farmers. On the first hand, maybe there is member contributions. This is very often the case of VSLAs, right? Because they all contribute to the cash of the VSLA, or cooperatives, which often have a social fund. And that contribution can be in kind, like land that they share, or equipment that they share, or cash. But also there can be, production that sells out of production or services that the farmers are providing. So this is revenue or income generated by the group itself. But maybe there are sources of income by the group which are external, like what we do as a NGO, providing maybe grants or subsidies or vouchers or discounts to the group. Or maybe it can be non-concessional, right? And this non-concessional, it's basically loans, and it's the type of access to finance that we often refer to when we talk about access to finance by small-scale farmers. But it's important to put this in the context of the wider income sources that groups of farmers often can have at hand. Let's look into how the income of the group of farmers and the investment costs and the running costs relate to each other. So, let's suppose that we are dealing with a group of farmers, whether that is a VSLA or it's a cooperative or an informal group of farmers or an SMEs doing farming. What is their income? In the ideal scenario, that income would eventually keep growing, right? In an ideal scenario. And what happened with the investment costs? That are very high at the beginning. At some point, you start the business, right? The farmer group starts as a business. So higher investments at the beginning. Then that investment cost goes down as you pay back that initial investment cost, but then maybe you realize that you need a new investment at some point, right? So then it goes higher again. Like for instance, you want to reinvest to expand the business. And what about the running cost? The running costs are more stable. This is why they are running. Every year you need to afford certain amount of seeds and fertilizers and other inputs for running the business. But as the let's say the size of the business expands, also steadily the running costs can increase. So as we said before, you have a high investment cost at some points, right? At the beginning, for instance, mainly, and also more steady running costs, right? And as I said, the investment the investment costs can also be high at certain points during the life of the business as you need to reinvest. So when we talk about different means for the small scale farmer groups to access funding, we have to keep in mind that there is a menu of options, but these different options play better according to what they are for, either for investments or for working capital. Let's consider first external investment. This is when you have an investors that actually put money in the investments, right, for investing in the business. You also have loans, and there are different type of loans. Maybe you get a loan from a public bank, right, which is something that is not happening that much anymore because there are not many countries having public banks lending to agriculture anymore. Normally, public bank funding, it's good for both investments and working capital. There is also private banks, which are very difficult to tap because they know that there is high risk in agricultural endeavors, but in principle, they should be available, or sorry, they could operate both for investments and for working capital. Then you have the microfinancial institutions, which in principle could only lend for working capital because it's short-term and a smaller amount. And the same applies with credit unions or cooperatives that are providing credits, called as SACCOs. Some cooperatives and VSLAs also have revolving funds, which is good enough for working capital, but funding is not big enough for investments, for capitalizing the business. There are other modalities that we will discuss later that we very seldom consider, like loan guarantee fund, right, which is provided by private banks. And the model is that to make the opportunity of lending to the farmers more attractive for the private bank, external party, let's say in this case CARE, guarantee that fund, meaning that if there is no payment back by the farmers, that could be covered by a guarantee, externally guaranteed. So if we do it that way, in principle, private banks could be able to be in a better position to lend to farmers, both for investments and for working capital. Then you have contract farming. I will elaborate later about that one, but basically here the idea is that the finance is not working from a bank, is not working from a bank, coming from a financial institution, but is coming from an agro processor. Or another mechanism is leasing, which actually applies basically for equipment and where you are getting the funding from an agro dealer. Finally, in the case of insurance, you get the funding from the insurance company. And of course, that is the modality that covers risk management type of funding needs of the farmers. Let me share with you some examples of what we above, and I will focus on examples which are not what we usually do at CARE, basically with the idea of expanding our way of thinking as we look into different ways for promoting access to finance by farmers. One opportunity is via COPs, and that is basically when you have a cooperative, which is member of a federation of cooperatives, so the funding is coming from the main first level cooperative that lends to the cooperative members of that network. Then there is contract farming, right? Which, as I said before, it's basically credit which is provided by processors or by traders to the group of farmers that are willing to sell to them. What are the pros? The pros are that the farmer get access to inputs because it's basically for revolving capital, for short-term inputs that the farmer needs for that season, and it's a guaranteed market. The buyers this way, the farmers, are securing the quality and the reliability and good prices in principle for those inputs, fertilizers, etc. they are getting. And there are limited transaction costs because you are getting them in bulk and directly from the trader or processor. And there is less risk of deviation because these inputs are going straight to the farmer. The cons, there are few of them. One is that it's not very good, this modality, for capital investment, only for working capital. It's not that a trader or the processor is going to lend a massive amount of money. It's basically limited money for the farmers to be able to access the seeds and fertilizers, but not to, let's say, buy new equipment or establish the business. Sometimes farmers may not match the standards required, meaning that, okay, they get the seeds and these inputs of whatever kind to produce, they go back to the seller with their production, and maybe because the production is not of enough quality, the trader, the processor will say, sorry, I'm not buying, right? There is also a risk of side selling by farmers, meaning that the farmers are producing thanks to this input they are getting, but then they sell their production not to the buyer, which is the deal, but to someone else. And very important, there is not always a fair deal here. Sometimes processors, when selling these inputs to the farmers upon condition that the farmers will sell the production to them, impose conditions which are not fair to the farmers. So contract farming, a modality to explore that we not look at very often in care. And also agroleasing, another good example of a modality that we do not consider that much in care. Basically, this means that instead of the farmer buying equipment, this basically applies for equipment, it leases the equipment from an agro dealer. So you don't need to buy your tractor, but basically you're renting the tractor. It's easy to understand. There is no need to collateral, which is of course the case of when you want to buy a tractor, it's expensive, you need a collateral. This is not the case because you are renting. There is no risk of a deviation because you will use the tractor for that purpose. And that basically is good also for the manufacturers of tractors because they can access new markets. Cons, this is not suitable for very specialized equipment because it would be high transaction cost. They may be, environmental dimensions that could limit the access to the equipment, and reposition of the equipment may not be always enforceable. But okay, the whole point here is that there is no one side for all mechanism for small scale farmers to access finance. There are different ways for that to happen. Also important to keep in mind that there is no magic formula. You have to look into case-by-case basis. Are we talking about access to working capital or investments, right? For instance. And finally, things may look very difficult, but when we try, then it may become easier. So a lot of this is about trying. Thank you very much for your attention.